Hey everyone. Before we get into today's show, I want to give a quick shout out to our sponsors, Coinbase Prime and Ledger. Love these companies, genuinely proud to call them sponsors of the show. You're going to be hearing all about them later from me, but now, on with the program. All right, everyone, welcome back to another weekly roundup edition of On the Margin. I'm joined, as always, by my co-host, Mr. Mark Yusko. What's going on, Mark?
Hey, not too much, Michael. Although I think we might have to change the name from On the Margin to On the Road. This is my third different spot to do this from. So I'm in San Francisco today. So excited.
You were bouncing around. Yeah, what takes you to San Francisco?
I was out at a pension fund meeting trying to convince them to allocate capital to blockchain and crypto. And then I'm going to hang out with my son and daughter-in-law. They just got a new house here in San Fran, so we do a little, honeydew projects for the weekend.
Nice, amazing. Well, it's a good week to be spreading the good word because it was a good week for Bitcoin here. I'm also excited because, I got some great Bitcoin charts. I also got this new video set up. So drop me a link in the comments. Let me know what you think. I told
you
Mark
are looking good, my friend. Sharp. Sharp is the word.
I tell you, I'm not sure I'm good looking enough for the HD level of this camera, but I guess we'll see.
Dude, I have a face for radio. Forget this video stuff. I have a face for radio.
I sent a video to our producer who helped me set this up last night, and I literally made that same joke. I was like, I got a face for radio, but other than that, everything is great.
Other than that, it's all good. Hey,
yeah.
Give the people what they want. They want high def.
Yeah. They do. All right, let's get into it this week because we got a big week, a whole bunch of great charts and stories for you this week. One sec. Let me just pull these bad boys up. First couple charts this week, all about Bitcoin. Obviously, a huge week for the biggest crypto asset. Through these two on here, first, I'll kind of walk you through my thoughts here, and then I'd love to get your interpretation. Yeah. So we're looking at rolling 1 month basis on all of basically the large derivative exchanges in Bitcoin. So you're looking at CME at the top, and then you've kind of got Deribit, Huobi, Kraken, etc. And then on the right, you're looking at open interest on CME. And what's really interesting is that, we've kind of talked in previous episodes about how usually the basis on kind of those offshore semi-regulated exchanges tends to be much higher. And the basis is the difference in between the futures price and the spot price. That has recently flippened. Credit to Josh Lim at Genesis for calling this out first. But that has actually changed, and now the basis on CME, you can see it by that yellow line at the top, has exploded. And you can also, that's complemented by the graph on the right, which is you just kind of see this explosion of open interest on CME. And what that indicates to me is that you're actually starting to see institutions, US-based institutions, wade back into the pool of Bitcoin, because that's really who'd be driving volume on this exchange. What's your interpretation of these charts when you're looking at it here?
Yeah, I think that's spot on, Michael. I think people have been throwing around this term Shocktober, that get ready for Shocktober, and happy Bitcoin Friday, by the way. So another good Friday for Bitcoin. Look, I was trying to make the case yesterday to a multi-billion-dollar pension fund that they need exposure. They had actually invited me to speak 3 years ago. They do this annual event, and 3 years ago I gave them the Get Off Zero speech. And what was amazing is they obviously didn't do anything. And I said, look, if you had taken 1% from your fund, not 10 or 15 or 20, just 1%, and put it in the fund, the pension fund would have made 10% compounded per year instead of 9.1 for the last 3 years. So that 1% would have increased the entire multi-billion-dollar pension fund by 10% return. And that's a pretty good deal, right? I mean, Bitcoin prices were $6,500 back then. And I said, and if you would have put it in our venture fund, which is up 7x since then, you would have had a similar outcome. And I think they started to get that, and in fact, so much so that the executive director came up to me after the break and said, the blockchain fund's not dead. It's not dead. We're still talking about it. Not everybody's on board. And so I think there's a lot of pent-up demand. I think you're seeing some real demand here. And institution is a funny word. So, is a Stanley Druckenmiller an institution? Well, yes and no. I mean, he's individual. Right. He's an individual with institution-like capital. But he would show up in this data. Or Paul Tudor Jones, or, a big hedge fund. that's different to me than the pension funds. Catherine Molnar, the visionary CIO, and Andy Spellner at Fairfax. I mean, those guys were early. They were in 2018. They saw the crypto light. They got out ahead of it, and their pensions have outperformed because of it. So I think the FOMO is beginning, but it hasn't even started. Like I keep quoting everywhere I go. At DAS with you guys a couple weeks ago. I've been talking about for a couple of years that we're so early. It's like the national anthem just started, and someone else at the conference said, "No, the players haven't even entered the stadium." So maybe the players are starting to enter the stadium, and some of those players are going to be some of the veterans from the institutional side.
Yeah. And I think it's important to call out kind of different segments of this market in general. Like, in my opinion, Bitcoin is kind of the only institutional crypto asset. Maybe ETH is starting to get there. But I think one of the reasons that we've sort of tread water for the last couple of months is because there have been kind of these larger macro concerns, everything that's going on in China, the ESG narrative. And when I look at this, I think one of the things that comes to my mind is maybe we've punched through some of that, and you're starting to see institutions wade back into the space. Another couple of interesting charts here in general is we're looking at BTC versus the S&P, so BTC against equities, and also Bitcoin's seasonality index. So the other thing that's interesting, right, and I'm sure I've also heard you talk about this as well, is kind of the uncorrelated nature of Bitcoin, especially when it comes to equities. And I'll be honest, for the last year or so, it hasn't really necessarily looked like that. But at the same time that we've seen the S&P and particularly the NASDAQ sell off, that's coincided with this latest run in Bitcoin, which is pretty interesting. At the same time, you called it Shocktober. I've actually called it Uptober myself.
Uptober. I like that better.
Uptober,
I like
baby.
Uptober
Yeah.
better.
Uptober. But the Q4 tends to be really good for Bitcoin, and we are starting to see that pattern resume. So I don't know, just some more context, I guess, for this.
No, really important. And the thing about correlation is correlation is really a long-term indicator. People try to look at short periods of time and say, "Oh, look, they're correlated." Look, in certain situations, assets can become and do become highly correlated, even if they're very uncorrelated. Stocks and bonds sometimes become very correlated, or gold and stocks, or Bitcoin and stocks. Well, why? Well, if you think about how markets ebb and flow, right? In just normal functioning markets, people are buying and selling the things that they want, and they're basing those decisions on different fundamental drivers. And so what happens is the assets tend to reflect different drivers, right? Stocks have different drivers than bonds have different drivers than crypto. But in extended moves, either up or down, everybody's doing the same thing for different reasons, called momentum or force. So in the up movements, things start to get correlated because everybody's just piling in, and they're just piling into quote unquote risk assets. But then in difficult periods, what has happened? You look at this like March of 2020. Stocks got crushed during the COVID crash, but then bonds went down, and gold went down, and Bitcoin went down. Wait a minute, those are supposed to be uncorrelated. No. In a liquidation that is basically leverage coming out of the system, you don't get to sell what you want to sell. You sell what you have to sell. And so the liquid stuff actually does worse than the stuff that needs to be sold. And I think that was the case definitely then. I think it was the case again a couple months ago in the April sell-off. But here, what I think you're seeing is a lot of the really nasty leverage got taken out of crypto. Doesn't mean there's still not people doing stupid stuff with 100 times leverage. There are. But most of that, at least my perception, most of that got taken out. And I think the other thing you're seeing is there's a classic movement of where people hold their coins. And if they hold them in cold storage, or physically in their hand, so to speak, then they're probably not likely to sell. If they move them onto exchanges, they're probably going to transact. And so we did see a pretty nice movement of a Bitcoin off exchange. And I think that could be part of the reason that you're seeing this divergence here is, look, stocks, particularly U.S. stocks, particularly U.S. tech stocks, are just so egregiously overvalued. It's crazy. Worse than 2000 in just silly town. Can't tell you when that's going to change. Maybe it's starting to change. But man, the government is going to do whatever it takes. A friend of mine just reached out to me from, I shouldn't say a friend, a colleague from CNBC just reached out if I wanted to have a quote this morning on, market resiliency. I go, it's not market resiliency, right? It's desperation by the power to keep financial assets levitated. So you saw the Guard this morning come out and say, oh, well, it might not be prudent to taper quite yet. Really, Christine, we've had 0 interest rates for 12 years. You tell me that we need emergency rates, like levels from the global financial crisis? What happened to the greatest economy ever? What happened to this big comeback? What happened to everything's great and happy and we should all be out and spending our money? You don't need emergency stimulus for that. So I think there's just a lot of potential downside pressure in traditional assets, and that could find its way into the new safe haven. Nobody likes to think of it that, but I actually think it really is.
Yeah. I think one framework as well that's been really helpful to me in this next chart, we're kind of looking at Bitcoin bull runs, however many days out from the happening, it goes back to 700 and then forward 700. And to give everyone some context, era 1 is kind of the 2012 to 2014 run. Era 2 is you're looking at 2015 to 2018, and era 3 is what we're currently kind of experiencing right now. And Lynn Alden in the first ever episode of this show came on, and I really like that point you made about correlations that kind of line up around smaller timelines. Her framework, right, is that the entire market kind of still trades around Bitcoin, and the overall, the most important thing to understand is the halvening cycle that Bitcoin trades around. And there are kind of these, Bitcoin will get correlated to different assets over periods of time. Right now, the focus is on equities. There's also a focus on interest rates and kind of what the 10-year is doing as well. But overall, the largest pattern that Bitcoin and therefore the rest of crypto tends to follow is around the halvening, and I think that's one of the most important things to understand. And if you look honestly, I know even just a couple months ago there was this question: are we still in a bull market? We've never had a 50-60% sell-off in the middle of a bull market. It certainly looks like we're on track for what Bitcoin has done in the past. So I don't know if you have any opinions looking at this chart, but
I definitely do. And look, I have wondered out loud, much to many maximalists' chagrin, that this cycle might have been truncated by Michael Burry and others who got short with all the crazy run up in January, February, and that clearly seems to have not been the case given the tremendous bounce off the July lows. However, if you think about this chart in particular, and you look at the peak in the 2013 cycle, we're past that peak, right? In terms of timing. If you look at the peak from 17 that everybody likes to focus on, we're right there. We're within days, weeks from that December 18th fateful day. Where we hit 20,000 and then it was all downhill from there, and so I do have some concern that cycle will repeat, because if it does, there's not a lot of gas left in the tank, quite honestly. And the thing I keep asking people to give me an answer to is where is the incremental demand going to come from? We all know the supply story, but in order for price to go up, which everybody wants, you have to have incremental demand. More money has to come into the ecosystem, and in the absence of the massive leverage pump that we've seen on multiple occasions in the past, it's still a long slog to get people in. And a dollar here, a dollar there with Bitcoin tipping isn't going to do it. You need real institutional adoption, as you said. You need, kind of an acceptance. And so that's a long way of saying it's possible that, this is kind of it. And now we're going to head into the consolidation phase. And the thing I do worry about a little, not a lot, and I was corrected the other day on Twitter. Someone, I said, name somebody who saw the drop from kind of August to November of 2018. We kind of crashed from 20 to 10, and then we rallied back, and then we kind of fell quickly to 6. And then we were stumbling along at 6, and everybody's like, oh, that's the bottom, that's definitely the bottom, and then we went to 3. And that's the part that I do worry about. Because if you did that same analysis with this cycle, and you said, okay, the cycle is over, and now we're going to go into this consolidation phase, and we're going to retrace back to the previous highs, that means we go into the 20s, and it would be rapid, and it would be painful. And I'm not calling for that. That's not my point. But so the point is, somebody said, well, Travis Kling called it. I'm like, well, I do kind of remember him talking about that. So I may have to give Travis a call and ask him what he thinks. But I'm still long. We are still long, and I'm still positive. But I do think this chart makes me a little more nervous about where we are. Now, one flip side. One thing you notice between the orange line and the blue line is there's like this movement forward. One argument you could make is that in 13, right, there were still very few people in this space. I mean, honestly, there were just almost nobody. 17, they're a decent number, but still pretty small. This time, there's actually a lot of people. And so is it possible that the cycle won't be truncated, but it'll actually be extended because there's people that started the process of adoption 3 months ago, 6 months ago, that are finally starting to make their allocations? No, that's a logical thought.
If I could present a slightly more optimistic counterpoint, I think one of the things that's maybe, I waffle on this quite a bit, to be honest, because I don't have a deep set of I'm not a trader, right? I don't look at charts, and I've got no technical analysis principles in mind. I do the same thing that every other middle IQ person does, and I kind of look and I'm like, well, this looks like a pattern, that looks like a pattern. What I will say, though, is I do think what might be a different factor in this particular run-up is that crypto has advanced, maybe not entirely to the world stage yet, but there are larger macro factors here than just kind of retail mania and sentiment. And we've never had something like what happened with China or the comments from the SEC and stuff like that. These are new developments. So it would make sense to me that large narrative push down and the outflows that were driven by those narratives might have extended the bull market in general. And, if you just kind of do some pretty basic back of the envelope math in the bull run for 2013, 2017, the whole market cap does something like between a 30 and a 50x, right? And we haven't really done that yet. And I think you could make the argument that, well, maybe we'll never see that type of volatility again because the space was just much smaller at that point. It took much less inflows of capital to make those types of price changes. But at the same time, you've never had the amount of real projects and developments that you have now. So I could kind of see it going either way. I will say we've kind of talked about this before. In terms of my own personal content diet, I love listening to traders. They are like the most interesting people for me to hear talk to. I consume tons of podcasts with them, but they're also the least useful for me because they just psych me out. They look at charts. They're operating on a super short-term time frame. I have no edge there. So the only thing that I can do, I'm just speaking for myself, is to take a long time horizon and try not to get too sick over the face ripping
Well,
volatility
there's a couple
that we all
things to
stomach.
that, Mike. Trying to extrapolate two observations as if there is a trend, that's folly, right? It's possible. It's possible that the third repeats, but there's no logical statistical reason why this should repeat. Now, there is a logic, right? There is a logic to the halvening cycle. But there's an absolute logic, and it's actually elegant in the design of the system, in that by reducing the block rewards, you are incenting price movement upwards, which creates momentum, right? Because the costs don't change. The miners' costs don't change on the day of the halvening, right? Their electricity costs don't change. Their rent doesn't change. And so they need a higher price in order to incent sale. And so you're actually seeing that, right? You're seeing miners holding coins a little longer. Now that is a speculation, but it makes some sense. And I think the chart here says that that's what happens. Post-halving, you get this gradual ramp. The speculative ramp, so that last upward movement in the blue tier in the first one, and then the we all remember November, December of 2017. Those aren't fundamental. Those are pure speculation, 100% speculation, and that's fine. I'm not saying that's evil or bad, but that is speculation, and that's why the price historically has always gone above fair value. So if you go back to my favorite chart from 2014, which is the original Metcalfe's law parabola, it basically said $10,000 of network value, $10,000 per Bitcoin network value on November 6th, 2017. Pretty good. We hit that within 6 days. But then we went right to 20. Well, 20 didn't mean the value went up. It was just the price went up. The price of the speculators got pushed. And so it was unsurprising that it was going to crash back down to fair value. Fair value by mid kind of 2018 was in the low to mid teens. And we went way below that, right? All the way down to 3,200. But then it wasn't surprising. We came back to that, and that number keeps going. Now, the problem with that original chart is it says 100,000 July of this year. So everybody's like, oh, well, look, we're way under the value. Well, Tim Peterson from N Squared Crypto did an update to that original graph where he said the decay rate might have been wrong, and here's my view. His Metcalfe's chart, which has been deadly accurate, says more like 30K is fair value. And so if we think about 2x of fair value as the speculative, that would put us at 60, which is kind of where we got. Yep. And so could we get back to that 60 level by the end of the year? Sure. But are we going to stay there? That one's tougher. So I don't have an answer, but I do think that we're seeing a lot of fundamental forces that are positive. There are increasing numbers of traders who are active here. It's funny, I was talking to a guy yesterday who was one of the original employees at Susquehanna. And he was just telling me how much capital and man-woman power they have put in place in crypto. So there's a lot of really smart money trading this. And I think that probably sets a different floor. I don't know that it necessarily guarantees us higher, but I think it sets a different floor. So I'm less concerned about the super crash than I am trying to find the incremental capital that's going to drive us higher.
Yeah, I think so too. we could keep talking about this all day, but I do want to get to some of these other these other charts here too. But look, it's all food for thought, and I think you called it out exactly right. We're literally operating off 2 data points here. There's no rational reason outside of the happening why this would all necessarily repeat. But just food for thought. This comes to us courtesy of Charlie Bilello. This is asset class total returns from 2011 till now. Just kind of interesting to look at all of this in general. I mean, the Bitcoin numbers are just pretty silly. It's like annualized its returns, 201%. If you look at some of the other big, second and third place, you're looking at the U.S. NASDAQ 100, which has done super well, and then just U.S. large caps in general, which is the S&P. There's quite a bit of overlap, frankly. I mean, if you just look at the top 5 companies in the S&P, I'm pretty sure all of those trade in the NASDAQ as well. Maybe Apple's in the Dow. I can't remember. But I mean, to your point, just tech has had such an unbelievable run of it for such a long time. And, honestly, if you want helpful context for me, I've consumed a lot of Grant Williams' work and podcasts on this. He's got a great episode with Jim Grant that will give you some unbelievable context for just investing over a long period of time. I think the concept, like we operate in crypto, so that's the idea of how do you wrap your mind around an exponential growth curve. But I will say the power of mean reversion is one that tends to be pretty consistent throughout history. So, I guess just something to consider.
There's a couple of things about this. So one, this is actually a pretty bad chart crime, in the sense that, well, I shouldn't say it. I was going to say if you torture the data long enough, it will confess. But I think what he's trying to do here, 11, 12, 13, 14, no, it's 10 and 3/4 years, right? It's not a decade. And so there's a little cherry picking of it, and why don't we go all the way back to 2009 when Bitcoin started? It's probably not a Bitcoin chart, and I like Charlie's work a lot, but I think part of the problem with this is, the first 5 or 6 years of Bitcoin to me they're not useful, and that doesn't mean to say that people who participated then, they don't get all the props and all the attaboys, attagirls, but they don't count. Institutions could not have put money in. It just wasn't an investable asset until probably 2016. You just couldn't have put much money to work. So I would take those early 3 years or 4 years just off. And when I talk about Bitcoin, I actually do this. I talk about the last 5 or 6 years. And the reality there is it's still a great number. It's still a great compound return. It's still better than everything else. And I was at this pension fund meeting yesterday, and they spent 7 hours, and they talked about everything, right? From bonds to stocks to interest rates to inflation to real estate to infrastructure. And we got to the end, and I said, I have 3 questions. So one, why would pension fund ever own bonds here, right? You're guaranteed to fail.
Yep.
No, you got return-free risk and nothing but downside. 2, why was there no discussion of the best performing private asset class, venture capital? You talked about private equity, you talked about private energy, you talked about private debt, you talked about infrastructure, never talked about venture capital, which is weird. And 3, why was there no discussion of digital assets? I mean, that just makes no sense. And so I think part of it is no one wants to look at this. No one wants to look at this number and say, oh yeah, how did we avoid the best assets? So for me, in trying to make the institutional case, I really only talk about the last 5+ years where it was institutionally viable and safe for people to think about putting their capital in, right? No institution was going to meet somebody on the corner and exchange local Bitcoins. It just wasn't going to happen. So,
yeah, that's totally fair to call out as well. I just think, I think it looks like he sorted this by. I was trying to get a sense. It looks like he sorted it by 2021 year-to-date returns in general. just an interesting chart to kind of look at and be aware
Oh
of.
no, and I love that. Like I tell people all the time, wait, how was Bitcoin the best performing asset in 2020? Right? It was tech. Well, no, it's Bitcoin. And how about 2019? It was tech. No, it was Bitcoin. And how about 2021? So, it's most years, right, of the last 5 or 6 years. Most years, Bitcoin has been the best performing asset. Yet, very few people still have exposure. It's a really tiny number when you think about it.
Yeah. No, it's super tiny. That chart that Raul over at Real Vision loves to show, which is just the growth rate of users in crypto, super encouraging, especially when you compare it to the early days of the internet. But yeah, definitely something to keep in mind. All right, this is a very interesting chart. Shout out to Will Beaumont, our researcher, for pulling this up. This is a UN Food and Agricultural World Food Price Index from 2006 to 2021. This is going to segue into kind of the latter half of this conversation, more kind of macro stories here towards the end. But if you want an indication of why food prices are so important, again, second reference to Grant Williams. He did a great episode with Russell Clark on the importance of food prices in general. But Russell's kind of key insight was that the price of food is it's kind of funny that we exclude food price from CPI. It's like
no, it's
CPI.
not funny at all, Michael. Remember what CPI is. CPI is not a measure of inflation, right? Again, we fooled everyone into thinking CPI is a measure of what the government uses to make cost of living adjustments in entitlement programs. It is engineered to be a low number. I mean, there is just nothing about it that is real or actual. The line I used to quote all the time is, as long as you don't heat or cool your house, send your kids to college, buy food at the grocery store, buy insurance, as long as you don't do any of those things, then there's no inflation. And this idea that food and energy should be excluded from an inflation measure, it's just folly. And it's because, look, if you had to actually increase Social Security or Medicare or Medicaid payments by actual inflation, there's a guy, Shadow Stats, that tracks this. And if you went back and calculated inflation the way they did in the 80s, I think we're at 8.5% or 9%. If you calculate it the way we did even 15 years ago, before they made the big change to owner's equivalent rent, we'd still be at 4 or 5%. So that's just not going to happen. So they're going to, again, torture the data until it confesses to get this. And Russell's a good friend, long-term. We've been long-term investors. He's the best. And his discussion of this was spot on, like almost to the day when he started talking about this. And this is just getting started, right? We haven't even thought about the implications.
I got to start checking with you before I start referencing all these people. I forget that you know literally everyone.
I'm old. Come on, I'm old. It's the benefit of being old. And look, Russell I think he's one of the best short sellers around. I mean, all deference to Mark Cohodes. But Russell's the best. And I said he's like John Burbank in that he is, paying homage to John here, being in San Francisco, although now John's in London with his new baby. But they are original thinkers. They are what we should all aspire to be, orthogonal thinkers. They think differently. They don't just accept what is put out there in the media or what's put out there in the popular press or what is consensus. They actually try to think differently. And if you do that, you can come up with interesting original insights, and you can be prepared. But this movement here that you're highlighting, again, if you're a technical analyst, you'd say, oh my God, this is the greatest cup and handle pattern I've ever seen, and we're about to go sky high. But the real reason we're about to go sky high is look what happened to natural gas prices. And that is the primary ingredient in ammonium fertilizers, nitrogen-based fertilizers, which are used to grow corn. So now all these farmers all over North America are going to have to decide, do I want to plant corn? I want to plant beans. If I plant corn, I got to buy fertilizer, which is like 2 or 3 times more expensive. So maybe I'm going to plant beans because I don't need the fertilizer. What's that going to do to the corn supplies? It's going to change them. What is corn used in? Well, things like ethanol and plastics, and a lot of our water bottles now are plant-based. So there's a whole bunch of implications that people just don't think about. And once a price spiral starts to occur, it's really tough to tame.
Yeah, I just think in general, and like this is going to segue into, I want to talk about the energy crisis that's going on in China right now. But like inflation, if you really zoom out and try to think about what that is, why it's concerning from a first principle standpoint, it's when costs rise above increases in wages, right? So that generally it acts as a tax on folks. So yeah, I totally agree with you. To exclude the volatile prices of energy and food, that's a lot of people's cost buckets, right? And food is the one thing that everyone needs, no matter what, right? So you should just look at this graph and think this is a tax. And especially this is a tax that's going to hit the lower income bracket of folks. And honestly, so I just want to set some context here for this next chart. We talk about housing a lot. This is the slide that we showed in last week's roundup. We looked at a lot of U.S. home pricing stats. This chart, I think I tagged you in this on Twitter, blew me away, which is the ratio of house prices to income by city. And here it is, like San Francisco and London, looking crazy at 8 to 9 times yearly income. Look at these numbers on Chinese cities. In Hong Kong, it is 46. 46. Yeah. I mean, it's 7 times more expensive to own a home in Hong Kong than it is in New York. I mean, that is, I was completely floored by this graph. All of this is kind of leading up to what is becoming sort of a dire situation, honestly, over in China. And I want to connect that to a couple larger picture things. But basically, it looks like there's a huge energy crisis that's going on over in China. A huge part of that is just coal inventory in general, which is at basically multi-decade lows in terms of their inventory. And it's causing a panic over there. 2 reasons why this is really relevant and important. If we zoom out for a second, and by the way, there's a focus on China here. I will say this is going on kind of all over the place. So you just called out natural gas prices, which are absolutely nuts. But also, I mean, there's the same shortage in China is going on over in India as well for coal. We're also, and that's impacting growth, right? So inflation, it's impacting growth. And also, I don't know if you just saw, there was a headline about, China sending over a record number of, I'm literally blanking on the name, but planes into Taiwanese airspace. And this is not my original thought. This person has asked not to be named, but I just want to. This is another person's line of thinking I want to give credit to, which is basically that as the situation gets more dire over in China, Xi, one of the strategies for remaining in political power is to kind of escalate tensions, right, with Taiwan to kind of distract from the domestic situation at home. So it has all these impacts for growth. It has all these impacts for like just global stability in general. I don't know, Mark. I mean, what do you think about kind of the energy situation, growth over there, and especially this kind of budding tension in between U.S. and Taiwan?
Look, the law of unintended consequences is writ large here. So we had this global response, to the pandemic that, with the benefit of hindsight, although a lot of people would have said with the benefit of foresight, was just a really dumb idea. And it's dumb on so many levels. One, it contradicts how human beings have dealt with viral infections for thousands of years. 2, it has to do with an interconnected global network of supply chains is fragile, right?
Yep.
And people forget how close we live to the edge. I don't know if I've said this with you, but I've told the story of, we had an ice storm in North Carolina a number of years ago, and we're down without electricity for 7 days. First couple days, no big deal, right? House is fine, you got enough firewood. Then you run out of firewood by about the 4th day. And now the refrigerator is looking a little empty, but there's no food in the store because you can't get in the store because you can't get the door open. It's like the Facebook thing, right? Facebook had other servers. They just couldn't get to the other servers because the login was tied to Facebook, shockingly. So, the lack of redundancy in supply chain is being felt everywhere. And whether it's, trying to buy a car or trying to buy a bike for your kid, there's those are little things that they're inconvenient. But when you talk about food or you talk about energy, look, there's this whole thing about climate, right? And coal is bad for the climate. Okay, that's a conclusion you could draw. Now you could actually look at it differently and say, well, how do we know over a 10-year period, if something is a 1,000-year trend, how do we draw a conclusion over a 1, 2, 5, 10-year period? It's a different way of thinking about it. And, there's also another school of thought, and it's something I actually ascribe to, that, solar activity really drives global temperatures more than anything else, right? Big nuclear reactor in the sky, if it's really hot and pumping out a lot of solar activity, we get higher temperatures. When it's not, we get cooler temperatures. And there's actually a very nice paper on this that talked about, we were likely to have a pandemic in 2019 because the solar activity was lower, and that's what happens, right? It's how the Great Plague got started with the grand solar minimum. There's all kinds of stuff that people overreact to one piece of information and it goes viral on the internet and everybody gets excited. So China shut down a whole bunch of mom and pop coal miners, for safety concerns, for environmental concerns. They're building a lot of nuclear energy, but some of it didn't come online. And to your point, now they have rolling brownouts and they have, on the verge of crisis. Then you throw on top of that, oil price changes because of the lockdowns and supply and demand issues. You got transportation issues. Look at the harbor in LA and just what happened with the ship dragging the anchor and causing the leak in the pipeline. Right. So there's just all these things that get interconnected and they start to snowball. And how bad is it going to get in China? It could get bad. And you're absolutely right. Governments, it's not just China, right? The United States, Russia. Right? Remember when Russia had their big recession around global financial crisis? What did they do? They started dropping bombs in Syria. Why? Because you fix GDP. And whenever we've had a setback, we just find someone else, find another desert to drop bombs in. They're like, oh, that's so cynical. I'm like, check it out. Go back and look at when we pick someone to, beat up on. And we come up with a reason, weapons of mass destruction that don't exist or whatever it is. And it's good for our GDP. Look, defense spending is really good for GDP. So would it be surprising at all to see Xi pump up defense spending to get their GDP up? No different than what the US or the Russians or the Europeans or anybody does. So governments love to spend money. Well, just look at the infrastructure bill that we're talking about. $3.5 trillion. Has anybody seen a list of what they're going to spend the $3.5 trillion on? Oh, $3.5 trillion. We got to spend $3.5 trillion. Well, why? And who's it going to go to? Oh, it's going to go to a bunch of people who paid a bunch of money into the lobbies to get special allocations. Oh, don't look at that. Not that I'm
honestly
cynical about that.
Not that you're no strong opinions. On the climate thing, I guess I don't have any strong. I have no edge, right? I don't really have much to contribute to that discussion. What I do think, though, is that I think one thing that troubles me a little bit when you look out into the world in general is I'm starting to see ideology trump pragmatism and fact gathering, and that's a pretty concerning development when you look at history. And you could go and look back. We've talked about the Cultural Revolution in China, but you can kind of look at what happens. And by the way, people corrected me on this. I was incorrect in our last roundup. I was getting equality and fairness confused, actually. They are different concepts, right? And if you have a fair system, then it's going to wind up looking unequal. And if you have a system where equality is at the center of everything, it's going to be unfair. And you actually need a rigid authoritarian regime to enforce something where you have fairness or equality, at the heart of everything.
Well, Michael, I just had a really interesting conversation with this, with what I'll call a philosopher king yesterday. Asset manager, does private investing here in California. Really, really smart guy. But he, as his hobby, studies philosophy. And all the things you're talking about are exactly at the root of what is going on right now. That there is a philosophical cabal that believes in this authoritarianism at the root to provide equality. So it's another form of Hegelian socialism or Marxist socialism disguised as modern economic theory, and it's some bad shit. I mean, it's really some scary stuff. And I think you summarized it so well. Is when ideology becomes the focus, you can get extremes. And I think, you're seeing that right now. Look, a lot of people have different views on China. I think what's interesting about Xi is he's upfront that everything that he does is all about philosophy, right? He believes in the heavens mandate. Right? He believes that Confucianism, that China should be the superpower, right? And everything in their 30-year plan is about achieving this return to 1800, the last 2,000 years. China's been at the top. He believes that the Chinese are deemed, from up above, that they should be at the top. So. Now, do I think people in the U.S. have similar beliefs? Absolutely. There's a group of people that absolutely believe that they're doing all this stuff, locking us down and forcing us to have papers and restricting movement and all. It's all for your own good. Nope. It's for power. And we're at a very, very tenuous juncture because we globalized, which meant we became interconnected and dependent on one another, right? Adam Smith, invisible hand, comparative advantage, all the good things.
Right.
And we actually have a pretty nice life around the world, right? We raised hundreds of millions of people out of abject poverty. We have a pretty nice life for most people. Doesn't mean there aren't people that are suffering. There are, but we have lots of philanthropic organizations that are trying to help that. And we got lots of good stuff. If you suddenly go the other way and go back toward these nationalistic, kind of independent, I just think it breaks. And we're seeing it break in lots of different places. And I just think we didn't plan to fail, we failed to plan, right? We just decided, we're gonna create a Cold War 2.0 with China because we need an enemy. Okay, well, what implications does that have? We outsourced basically all of our manufacturing base to China over the previous 30 years. So maybe there's some implications there. So I don't know. We're at a very, very strange junction. I don't think it's super dire yet, but to your point on the food prices, there's some scenarios where it could get just painful, right? And especially for, unfortunately, the average person. right? Because the average person, they don't own a lot of financial assets. They don't own a lot of property. They don't own a lot of things that everybody's all excited that they're rising in price, but it's money illusion. It's just, housing prices, that chart you show, that's not real. That's not economic value. Houses don't grow, right? They actually wear out. You got to work on them. What happens is the money that you're buying them with is devaluing. And there's a race to the bottom globally to devalue your currency to try to take share of a shrinking pie. And that is a very dangerous place to be, because I defy anyone. I've said this on Twitter. I've said it on TV. I defy anyone to tell me one example where any country profitably spent and printed money that led to long-term prosperity. I'll wait.
Howdy, everyone. This episode is brought to you by Coinbase Prime, the leading prime brokerage solution for all things digital assets, providing secure custody, trading, and financing to an institutional suite of clients. On the retail side of things, I am more than happy to make this endorsement because I have been a customer of Coinbase since the day that I got into crypto. I still keep the vast majority of my assets there, actually, and I do it for one reason and one reason alone, so that I can sleep easy at night knowing that my funds are safe. It's the same reason when family or friends ask me, where should I buy my first Bitcoin? I direct them to Coinbase. And now, finally, when institutions are starting to ask, what's the most safe infrastructure to use? I only point them in one direction, to Coinbase Prime. And the reason that I do that is because it is peace of mind. When it comes to security, everything is top of the line on this platform, and it's a white glove experience to boot. They've been securing client assets at scale for 8 years, which as of Q2 of this year is $180 billion. They have an industry-leading insurance policy, and they're audited by blue chip auditors so that you can sleep easy at night too. So stop listening to me, click the link at the bottom of this episode, and go check them out for yourself. And when you get there, tell them that I sent you, because I love to get credit. When it comes to crypto, security and custody is paramount. Introducing this episode's sponsor, Ledger, your secure gateway to buy, exchange, and grow your crypto assets. I know I've got a smart audience, so I'm assuming/hoping that most of you already have your Ledger hardware wallet, but just in case you don't, this is how I think about it. I wouldn't get into a car if I couldn't wear a seatbelt, and I don't operate in crypto unless I can do it from my Ledger hardware wallet. Crypto is really exciting, but it is still the Wild West. There are lots of risks, and Ledger is the easiest way to make sure that you are still protected. And the best part about Ledger is that you don't need to make any trade-offs between security of your funds and utility of your assets, because Ledger has Ledger Live, which is a software. It syncs right up to your Ledger hardware wallet, and you can do anything that you'd want to do with your crypto assets. You can easily send and receive, you can buy and exchange, and you can get access to staking. And they've actually started to aggregate some of the best DeFi apps and services out there. Two of my favorites, Paraswap, a decentralized aggregator, and they've got Lido for staking. And stay tuned, I'm going to keep you guys updated. They've got some really cool services coming out soon. Aave, Compound, and 1inch among them. So if you take one thing away from this, guys, please make sure that you're protected in this space. Get yourself a Ledger hardware wallet today and start using the Ledger Live app. Click the link at the bottom of this episode. Thank me later. The reason I tend to tie things back to philosophy and history is because that's my interest and that's my background in general. And just to frame for everyone, why do we talk about the things that we talk about on the show? Why do we talk about housing? Why do we talk about inflation? All of that kind of stuff is because when you look throughout history, the most consistent trend of all time is that when you have disparity in terms of wealth and inequality rises, there are transitions. And one of the great things about having a podcast and writing in general is I can kind of track my thoughts over time. And I said this on the last interview is like, I feel like sometimes I alternate in between being very excited about the future and everything that's going on, especially in crypto, and just being extremely concerned about everything. And I try to be introspective about why maybe I alternate in between those two frames of mind. And I think the reason is I think we're headed towards a point of transition. History is filled with these sort of transition points. And when governments and people handle them well, then you can see an explosion in prosperity. You can advance the next 100 years, whatever it is. But also sometimes those transitions aren't happened super well or aren't handled really well. And, there's more negative outcomes. And, there's a great interview that Dmitry Kofinas did with a guy, Simon Mikhailovic. that just really made me think. And there's so many analogies. This is a guy who escaped Soviet Russia before the Soviet Union, before the downfall and everything. And Dimitri kind of asked him, like, well, did you think that this was a system that could go on forever? Like, were you surprised when it eventually fell? And he was like, we all knew that it was unsustainable, but I was still surprised when it fell because, it's the difference between knowing and then experiencing something that you think is unthinkable. And I think the one thing that I would look out for over the course of the next decade or so is for some truths that we all hold to be fundamental will change. And the last thing I'll say on this rant about history is, if you go back to Rome, which is the example that I constantly use, for the first 500 years of Rome, it was a republic. And that was core to every citizen's value prop, right? Like, we don't have tyrants here. We don't have kings. It was baked into the fundamental cultural value of the entire civilization. Yep. And then it transitioned to an empire. And the reason that it transitioned to an empire was because they went through 60 to 80 years of civil war. And eventually, if things get bad enough, everyone just says, screw this. Screw this. I don't care about my ideology. I don't care about the values. I need certain things as a human, like I don't want to be killed or I don't want to have my family killed in pointless civil wars. So that's the reason why we relate it to history, and that's why we kind of bring these things up all the time.
Yeah, the farther back you see, the farther back you look, the farther forward you can see. You want big ideas, read old books. There's nothing new in this world. To your point, you can track everything back to the philosopher kings of ancient Rome. Everything from leadership manuals to ideas on how to be a good person. One of my favorites is from Seneca the Younger, right? Failure changes for the better, success for the worst. When people are super successful, they actually don't change for the better, they get worse. And when people fail, they actually learn and they come back stronger and they become resilient. And we have a whole society today that doesn't allow people to fail. We don't keep score in kids' soccer games because someone might lose. We have this whole participation trophy idea. So kids aren't resilient. They don't know how to fail. They don't know how to bounce back. It's endemic in societies as they age. And to your point about this tipping point, it's happened every single time, right? When people become full of hubris and they think their way is the only way, and they try to impose their will on the masses, and you concentrate power at the top through cronyism. The end game is not pretty, and to your point, it usually ends in revolution, which I'm not calling people to take up their pitchforks, but I am saying that if you're not concerned, you're just not paying attention. And I echo your thought on, look, I love Twitter because it's a micro blog. And I love the fact that people go back and call me out on stuff and say, hey, you said this. I'm like, well, yeah, I changed my mind 4 times, but thank you for pointing out that I did say that. And I love the feedback you get instantaneous. I love the people that comment on what we're talking about. But writing, speaking, thinking are things that we should all do more of. Right?
I agree.
Just passively taking stuff in and regurgitating isn't really very valuable. Taking information in, thinking about it, forming a belief. To your point earlier about data, right? If you reject data that disconfirms your hypothesis, you are not scientific. You're anti-science. I mean, science is about gathering data, testing the data, evaluating the data, then forming a conclusion. You can't have the conclusion before,
the data.
But part of the problem is how social media works, right? It feeds us more of what we like and less of what we don't. And in fact, sinisterly, if that's a word, even more sinister, it feeds us the antithesis of what we don't like to propagate that feeling of disdain or feeling of hatred or non-acceptance or confirmation bias of oh, well, of course we're right. I mean, people need to seek out dis, you know, dissenting opinion. You need to talk to people who you disagree with. You know, you need to engage in a dialogue and debate in search of truth, as opposed to trying to convince the other person of your point of view. So maybe you and I need to fight more. No, I'm just kidding around.
No, I don't think so. I think, and you know, that point that you made about flip-flopping, I know we're running low on time here. I got like two hot seat questions for you here right at the end. But that point, there was a great quote from Su Zhu, who's an investor at Three Arrows Capital in this space. He said, the desire to be consistent with oneself is the source of poor decision-making. The winners of The Big Short, this is a direct reference to Michael Burry, but the winners of The Big Short came to define themselves as bears and proceeded to underperform everyone for 13 years. There's never a need to define yourself. The market does not care who you are. And the political, I've always, you know, people accuse politicians of being flip-floppers. There's that great quote from Winston Churchill. It's like, when the facts change, I change my mind, sir. What would you do? You know, what do you do? It's like,
no, Lord Keynes. Lord Keynes. Oh, he's giving a speech.
Keynes?
Yeah.
Okay. Well, it's like, you know, people look at, you know, these politicians and they wear it as a badge of honor. I've said the same thing for 30 years. Like, okay, maybe you should have, you know, not everything has stayed the same for the last 30 years.
When the facts change, I change my mind, sir. What would you do? And if look, strong opinions loosely held. I am infamous, I guess, for my opinions. Yusko is just always so full of these opinions. I'm like, yeah. Opinions is what makes investing possible. If you don't have conviction, you will not act. If you don't act, you can't win. Now, you can also lose, but you have to have conviction. You have to have the ability to reach a conclusion. But then you have to be able to change your mind. You have to be able to flip-flop. If someone has a better argument, where if information changes or the world changes or, you know, technology changes, whatever it is, that's the basis of living a better life, is the ability to move forward in the presence of increasing, you know, change and not be paralyzed by it because you cling to your, you know, one view. Plus the other thing is, as you go through accumulated experiences, you have more tools and more data to do the analysis and make decisions. So how could it ever be that the opinion you held in the past is the only one that's right? It doesn't make any sense.
Makes no sense. All right, Mark, hot seat questions here. I do want to get your opinion on. I guess I should ask if you actually know her to not repeat my mistake. But George Soros' family office this week just disclaimed that they own Bitcoin via their CEO, Dawn Fitzpatrick, who is one of my all-time favorite people to listen to speak. She is freaking awesome. So two reasons why I'm pointing this out. One, just that whenever someone is major as an individual, whichever, I love that word, individual, like Soros says that they're in the game, that is significant to me. This kind of reminds me personally of when Paul Tudor Jones kind of came out and publicly said, hey, we own some Bitcoin and Druck right before the run, you know, in Q3 or Q4 of last year. So maybe a bit of a similarity there. They don't tend to get things too wrong on the timing. And then the last thing is that they also said, while Bitcoin is interesting, they're more interested in some of these DeFi applications of crypto in general. What's your take on kind of this story?
There are few people who are as legendary of an investor as George Soros. There are few people who have had as many legendary investors work in their office as George Soros. And it is absolutely and definitively a huge positive that someone like Dawn has made a public discussion of that. Now, not surprising, right? They have been early for decades in identifying trends. And look, there's so many great Soros quotes. I actually wrote a long letter all about Soros and all about all of his quotes and all of his wisdom. I can even get it to you and we can post it somewhere because it's actually one of my better letters. I actually got clients from it. They read that letter. Wow, I didn't know all this stuff about Soros. He is one of the truly legendary investors, and his ability to identify talent and mentor that talent. But he makes decisions quickly. And the thing I love is he focuses not on point outcomes, but on scenarios, right? The idea that any of us know what's going to happen is folly, right? There's the upside scenario and the middle scenario and the downside scenario, and you have to plan for all of those different scenarios. But the last thing I'll say that the thing he's really good at is what you call phase shifts. And things change in stair steps. And right before a big stair step, you'll get a phase shift. And what happens is it's like the molecules in water as they decide to go either to steam or to ice. They start to vibrate wildly. And so when the volatility of something starts to amp up, you're at one of these phase shifts. And I think that's what we have seen this year. And I would not be surprised if, as usual, he and she will be right on. And the extrapolation into DeFi, anyone who poo-poos DeFi and poo-poos this idea that this transition from TradFi to CeFi to DeFi isn't going to happen, they just haven't spent enough time on the technology. The more time you spend on the technology, the more you see that smart contracts are the future for financial services, derivatives. Human beings don't need to be involved. They're fallible. Some of them are actually bad. They do bad things. And in code we trust.
Yeah, completely agree. And if anyone's looking for a fun read here, the other thing George Soros I think coined was this idea of reflexivity, obviously super relevant for crypto in general. But if anyone's looking for a fun read, just go read the Wikipedia page for Black Wednesday, which was in 1992 when Soros and Druck broke the back of the British pound. Just an unbelievable story in finance history, and it's just fun to read about how unbelievable.
No, it is. It's awesome, but reflexivity is one of the most important concepts in all of investing. And it's a philosophical. I mean, Soros is truly a philosopher king. Now, the first book that he wrote is horrible. I mean, it's one of the worst books ever written. It's unreadable. But the second book, where he talks about the first book and the idea of reflexivity, is awesome. And then I said I wrote this piece that kind of gives the summarized, the Cliff Notes version on reflexivity. If anybody cares.
Yeah, I mean, if maybe this week or next week we can get that in the roundup notes, just so folks can read that, because I would love to read it as well. Last big story of the week that I want to cover with you here is apparently the FDIC is said to be studying deposit insurance for stablecoins. So just a couple of key points. So that FDIC stands for the Federal Deposit Insurance Corp. It's a key U.S. banking regulator. For those of you who don't know, in simple terms, it's the government entity that basically insures everything up to $250,000 in your bank account. So basically, even if the bank who is really your counterparty that you're putting your money with defaults or goes out of business or there's a run or whatever, the government essentially guarantees funds below 250 grand, and they're looking into doing that for stablecoin deposits. This is unconfirmed, I should say. I think CoinDesk was the one that broke this. There were about 5 different sources. Feels pretty relevant to me, just because from a safety perspective, I'd like to know, right, that anything under 250,000 is basically guaranteed. What do you think about this story in general? Big, significant development, not so significant?
Yeah, probably a fad. You knew I had to say that.
Give me the hashtag.
Probably a fad, and the arrow, and the rocket. Look, it's a monster development. Now, there's two sides of it. It's a monster development in that it is an acknowledgement that these are here to stay, so that's good. It's an acknowledgement that they are a viable deposit mechanism for people's assets. But it's also a statement that we're going to be in charge. We being the regulators and the overall, kind of Politburo of finance. And as I said, I have been an admirer of the SEC up to this point. In their regulation of crypto, they've been measured, they've been prudent, they've been consistent, which is not necessarily their hallmark over all the years. And I think they've been pretty progressive, right? I mean, like it's crazy that we still have 1930s, legislation that governs regular securities. Absolutely ridiculous.
Totally.
And, accredited investor standards, dumb, right? Stupid, right? It's just protecting the rich and fomenting income and wealth inequality. Of course, that's the plan. But I actually think that they continue to impress me, at least so far, although some of the things that Gensler says are a little more frightening. But this is a really positive step. Some will look at it and say, oh no, it's sinister. They want to get their dirty clutches on these things. And sure, why not? I mean, what is an institution or a company that takes deposits, lends them out, and pays interest? Well, that's a bank.
A bank.
The banks don't want to call it a bank, but that's okay. And these assets are different than fiat. They've not been deemed, currency yet. They're still considered property. So, look, it's a step in the right direction, but it's kind of like, oh, these things have become tens of billions of dollars. They're probably not going away. Okay, we better get our arms around them soon. So let's give something good. Okay, insurance is good. Now they need to run it the same way they do. The thing with the FDIC, it's a beautiful construct as long as less than 3% of the banks fail at the same time. Because that's all the money there is in the system. So it's a very undercapitalized insurance company. So the idea that everybody's $250K is safe, just crazy.
I did not realize that.
It's run the way it should be run as an insurance company. Everybody pays in their premiums, and then there's a pool of capital. And think about it. If a hurricane wiped out the entire United States, there wouldn't be enough money in the insurance companies to pay. Now, if a hurricane wipes out one part of the United States, then it can pay, and then it can collect more premiums and replenish. And so it's worked great, and it's structured properly, and it's the right way to do it. But what we all have to remember is it's not, like I joke, and I love my mother. I mean, I love her. But I joke, she believes there's a little pot of money in DC called Judy's money. I'm like, Mom, there's no pot. And like, no, I've been paying in all these years. My money, no. Your money got paid out to Grandma and Grandpa, and my money's paying you, and hopefully my kids' money will pay me, although I don't have enough kids to support me. But so it's a pay-as-you-go system, and it should be run as an insurance company like Singapore does, Medicare and Social Security. At least the FDIC is run like an insurance company, and it actually functions really, really well. But it got really dicey when La Jolla Savings went under One West Financial and John Paulson, Soros,
right,
and us, actually. So that was actually a really cool thing. So Soros, Paulson,
Yusko,
I can't remember the other two, bought 24.9% of the bank out of bankruptcy. The FDIC guaranteed us 2 times return on our money on day one, so there was no risk. And there was, individual can only own 24.9% for regulatory purposes, so there was 0.4 left over. So Morgan Creek got that 0.4%, which was awesome for our clients. So I love the rounding pennies. But again, it was Soros right there at one of the great investments. I think we ended up making 7 times our money on it. But the FDIC is great. It's a long answer to your question, but it's great. I'm glad that this construct is being talked about. But what we would need is premiums paid by these financial services companies and protocols into a pool to make it work. And I think we should. And I think now, should it be a DAO instead of the FDIC? That would be interesting.
Yeah. That's, what? The transparency aspect is key, because hearing you say that, I had no freaking idea that that's how it worked. That's why, I have thoughts about decentralization, and everyone in crypto is like, decentralization equals good, centralization equals bad. And I'm not sure it's that simple. I do think one of the things that we deserve out of DeFi is transparency. People deserve to at least understand how shit actually works. And I feel like that would be enough for me. Now, speaking of progeny and people supporting you, I know you're with your kid in San Francisco, so you've already given me a ton of time here. But man, I feel like we could have kept talking because we're getting into some really interesting stuff here.
I'm so grateful that you asked me to join the team. This is a blast, and I think it's going to be very valuable for us to have this long-term history of these conversations.
Yeah, it's a ton of fun, man. I'm having a great time. And for everyone who's stuck around and is listening to us this long, guys, give us some feedback. We'd love to hear from you. We ultimately do this for the audience. So drop some feedback in iTunes or Spotify or YouTube or however you're listening to this. We'd love to get your input. And with that, I will let you go, my friend. I'll see you here next week.
We'll see you next week. Have a good weekend.